Welcome to the True P&L Deep Dive. Before we start, a quick disclaimer. This analysis is for educational purposes only. Analysis is opinion. Adjusted data reflects my personal proprietary AI models and may differ from official audited statements. This does not constitute financial advice. Always do your own research. Now let's get into the numbers. So today we are launching our forensic investigation into Commercial Bank of Ceylon, or COMB, looking specifically at their Q3 2025 financials. And if you just glanced at the headlines, you'd think everything is absolutely perfect. I mean, we're talking about a reported profit surge of 52.4%.
Huge number.
Huge. It hits an impressive 47.35 billion rupees.
Yeah.
And management has framed this as their triple engine story.
Right, the perfect narrative.
Exactly.
Right.
Expanding margins, falling impairments, and aggressive loan growth. It sounds, on the surface, like the perfect recipe for sustainable, high-quality profit.
And that narrative, that triple engine story, is precisely why we do this. The market loves a simple story, especially one where, everything is firing on all cylinders.
Of course.
But our job is to immediately challenge that, to ask, is this real? Is it structural and sustainable? Or is it just a temporary peak? When you see a number like 52.4%, you have to go looking for the fault line.
The Achilles heel.
Precisely. And for COMB, that line is drawn right through their reported asset quality.
Okay, let's unpack that, because this feels like the core anomaly that really sets the tone for the whole analysis. The bank reports its asset health using the standard metric, the non-performing loan ratio, the NPL ratio.
The one everyone looks at.
The one everyone looks at. And by all accounts, it looks spectacular. It dropped from 2.76% all the way down to 1.79%.
A massive improvement, almost a full percentage point. On paper, that suggests a much, much cleaner loan book.
It does. It suggests their underwriting has gotten significantly better, but that's where the contradiction comes in, isn't it?
It is, because that's the headline the bank wants you to see. But to really understand what's going on, you have to ignore the ratio for a second and look at the absolute raw data. We need to define our terms here for you.
Yeah.
We're talking about stage 3 loans.
Right. These are the really bad ones.
These are the loans that are already 90 days or more past due, the ones with the highest chance of default. And what does that raw data show? The absolute volume of these stage 3 loans. It didn't fall.
It went up.
It went up.
Yeah.
Noticeably. The balance climbed from 86.34 billion rupees to 94.68 billion.
Let me make sure I'm hearing that correctly. The ratio, which is the public-facing number, dropped by 35%. But the actual amount of money in near-default loans went up by over 8 billion rupees.
That's right.
86 billion to almost 95 billion. That's a significant jump in real dollar-for-dollar bad loans.
Yeah.
So how? How is it even possible for the headline ratio to look so good if the underlying problem is getting bigger?
This is a textbook, and I mean a textbook example of the denominator effect. It's maybe the single most important concept to grasp when you're analyzing a bank that's in a high-growth phase.
Okay.
The NPL ratio is just a simple fraction. You've got stage 3 loans on top, the numerator, and the total loan book on the bottom, the denominator. And COMB's strategy was just pure aggression. The total loan book, the denominator, expanded by a colossal 25%.
25%. So they added 381 billion rupees in new lending.
Exactly. So think about it. They took this pool of bad loans, which was growing, and then they just diluted it by flooding the balance sheet with a quarter more in new, currently performing loans.
So it's a mathematical trick almost. If your total book grows by 25%, your bad loans have to grow by 25% just for the ratio to stay flat.
You've got it. Since their absolute bad loans only grew by, less than 10%, the ratio just plummeted. It's dilution.
So the improvement wasn't because they magically stopped creating bad loans. That 8.3 billion rupee increase proves they're still forming. It's because they were just growing the good part of the book much, much faster.
They're outrunning the problem. It's a strategy that effectively masks the continued formation of credit risk.
Well, this immediately throws up a huge red flag for me on the whole triple engine story. We have to ask, is this 25% growth being driven by genuine confidence in the economy? Or is it a high-speed chase where the bank is just slamming the accelerator to stay ahead of its own rising credit issues?
It demands caution, that's for sure. The clear implication is that their internal credit cycle is far from clean. And think about the risk here. If that 25% growth slows down next year, or if some of that new $381 billion in loans starts to go bad.
Which is pretty common after a period of rapid expansion.
Very common. Then that denominator effect just vanishes. It disappears.
Yeah.
And the NPL ratio will snap right back up, reflecting that much higher 95 billion rupee absolute bad loan balance.
And this ties right into the second part of their triple engine story, those falling impairments. The impairment charges dropped significantly, down 28% to about 14 billion rupees. That drop is a massive boost to the bottom line. It explains a big chunk of that 52% profit surge.
And management's explanation is that it's normalization. They're saying it's coming down from a very high base in 2024, which is fair. That base included huge provisions against sovereign bond risk.
So there's some truth to that.
Oh, absolutely. The normalization part is real. It's a necessary tailwind after a period of macro stress. But, and this is the key, you cannot look at that impairment drop in a vacuum. You have to see it next to the rising absolute stage 3 loans.
Because if the amount of distressed loans is actually going up,
Then you have to question how long this accounting normalization benefit can last. At some point, you have to provision for the higher base of genuinely bad loans that you're accumulating.
So, to sum up this first part, the profit boost from lower provisions is real. It's in the bank account. But the underlying engine creating the risk, the actual formation of bad debt, is still running hot.
Precisely. You have a structural issue being temporarily masked by a short-term cyclical benefit. It's a critical distinction to make. The headline says credit risk is gone, but the raw data says the bank's growth is just absorbing the pain for now.
Which means if we want to believe in this profit number long term, we need to find other engines, real structural, reliable profit engines, not just temporary accounting relief.
Exactly. So let's move on and see if they generated quality revenue through smart operations.
All right, let's pivot. Let's look at the actual operational health of the bank. This is where we find out if CLMB is making more money because they're just, a better bank, more efficient, better pricing, high-quality earnings.
And we should start with net interest margin, or NIM. The absolute core of a bank's revenue is net interest income, NII. And that grew a very strong 16.3%, hitting over 103 billion.
Which is excellent performance.
It is. But the really interesting part is how the net interest margin expanded. It moved from 4.27% up to 4.53%. Now, normally, when a bank is growing its loan book by 25%, you'd expect the NIM to be under pressure. They have to go out and fight for deposits, tap expensive funding.
And that usually squeezes margins. But that's not what we're seeing here. The data shows their interest income, what they earn, rose a healthy 6.96%. But the real magic is the interest expense, what they pay out.
Right.
It actually dropped a tiny bit, 0.08%, but it dropped. Even though they grew their total deposits by a massive 283 billion rupees.
Yeah.
How do you do that? How do you take in more money but pay less for it on average?
It's not impossible, but it's extremely difficult. And it points to excellent management of their liabilities. This right here is the structural profit engine we were looking for. And it all comes down to the liability mix.
Okay.
Specifically, their successful optimization of the current account and savings account ratio, the CASA's ratio.
Let's quickly define CASA for everyone listening.
Sure. CASA is the cheapest, stickiest, most stable funding a bank can get. Current accounts usually pay 0 interest. Savings accounts pay very, very low rates. You contrast that with a fixed deposit where you have to pay a competitive market rate to get that money.
And COMB managed to improve their CASA ratio from 38.7% up to 39.92%.
That 1.85% shift might sound small,
Yeah.
but on a balance sheet of trillions of rupees, the impact is enormous.
Let's try to put that into perspective. For a bank this size, every single percentage point they shift into CASA means billions of rupees are moving from an expensive liability into what is effectively a free or near-free liability. So by improving this by almost 2 full points, they completely neutralize the cost pressure that should have come from taking on 283 billion in new deposits. It's like they grew the cake while simultaneously cutting the cost of the flour.
That's a perfect analogy. That is the structural driver of their NIM expansion. It wasn't a fluke. It was engineered. They successfully persuaded customers to keep their money in these cheaper accounts. That gives them a durable advantage that should last for multiple quarters. This NIM expansion is high quality. It's real.
But is it truly structural? I mean, couldn't the bank have just run some aggressive short-term promotions to attract those cheap deposits, and then they might lose them next quarter when a competitor offers a better rate on a fixed deposit?
That is a fair challenge, and it's always a risk. If it was just a one-off campaign, it would be transient. But the trajectory here suggests it's a bit deeper. They're approaching that 40% CASA level, which is very strong for a regional bank. It shows they're effective at retaining sticky, low-cost retail customers, which is the holy grail of banking.
And this low funding cost underpins everything. It provides a cushion against rising interest rates.
It does. And this high-quality revenue generation leads us right to the next measure of operational excellence: cost discipline. Let's look at the cost-to-income ratio, or CIR.
The CIR. This is our efficiency metric. How much does it cost the bank to earn 1 rupee of revenue? And the number here is, frankly, stunning. COMB dropped its CIR from 33.85% down to 27.95.
It's exceptional. For a regional bank, especially one growing this aggressively, anything below 30% is considered world-class. It suggests incredibly tight control over their expenses.
But is that 27.95% sustainable? I mean, when you have massive revenue growth like that 16% NII jump, it can temporarily make the ratio look better because the denominator is so big?
That's true. High revenue definitely helps.
Yeah.
But you don't hit a number like that purely by accident. This low CIR confirms two things. First, really efficient operational management, probably through digital adoption and branch optimization. And second, it shows the compounding effect of that high-quality NII growth.
Because they used cheap asset funding.
Exactly. The income side of the equation swelled without having to inflate the expense side. So if they can maintain that low funding cost, this CIR could very well be their new, efficient baseline.
We should probably just acknowledge the contribution from non-core activities, though. While the NII and fee income are the bread and butter, there were some other boosts that added a bit of volatility.
That's right. You look at their trading income, and it's a huge reversal. They went from a 3.72 billion rupee loss last year to a 0.72 billion gain this quarter. That reversal alone is a 4.4 billion tailwind.
And then there's this massive 67% jump in other operating income, up to 16.29 billion. The footnotes confirm this was mostly from significant foreign exchange gains.
And those non-core parts are the cream on top, but we have to label them as volatile. FX gains especially, you can't rely on those quarter after quarter. They're a nice one-off boost. But the foundation, the core story, is solid. Structural margin improvement from CASA and incredible efficiency from the CIR.
So, synthesizing this section, we've established the bank is structurally generating better revenue and spending less to do it. The operational health looks fantastic, but now, the ultimate test. Does all this accounting profit actually turn into cold, hard cash?
This is where the rubber meets the road. We have to pressure test that income statement. A big headline profit is, frankly, meaningless if the bank isn't actually collecting the cash it needs to pay dividends, fund its growth, and stay liquid. So our focus now is the cash conversion ratio, the CCR.
And the numbers here are really compelling. The reported net profit, the accounting number, was 47.35 billion. But the adjusted operating cash flow, the actual cash generated, was 78.68 billion.
A massive divergence.
It's huge. And when we calculate that CCR, we get an astounding 1.64 times.
A cash conversion ratio of 1.64 is, well, it's exceptional validation. It means that for every single rupee of accounting profit they reported, COMB generated 1 rupee and 64 cents in actual physical usable cash.
That gives you very high confidence that they're not playing any accounting games, like recognizing revenue too early before they've collected the cash.
In fact, it's the opposite. It tells you there are significant non-cash expenses on the P&L that are depressing the profit number, and those get added back when you calculate the cash flow.
Okay, so let's deconstruct that powerful multiplier. Why is the cash generation so much higher than the profit? We need to separate what's structural from what might be a temporary boost.
The first and most important structural reason goes right back to our first section: the treatment of non-cash impairments. Impairment charges are just provisions. They're an expense of the P&L, they reduce your accounting profit, but no cash actually leaves the building.
Right.
So when those impairments normalize or decline significantly, like they did this quarter, dropping by that 28%, that reduction acts like a cash inflow when you reconcile the numbers.
So the same impairment drop that boosted the profit by 52% also acts like a powerful cash magnet. It confirms the money they saved on the P&L is actually sitting there in cash.
Precisely. And this also helps explain why, even though the absolute number of bad loans went up, the cash conversion is still strong. The cash impact of provisioning for those new bad loans is delayed. The second structural driver this points to is simply efficient collections.
Which speaks directly to the quality of their credit management, not just their accounting.
Absolutely. A bank can report huge interest income, but if its customers are slow to pay, the cash flow statement will look terrible. A 1.64 CCR suggests management is incredibly effective at turning what's due on paper into physical cash received.
So strong internal treasury, strong collections. They're focused on realized returns, not just recognized revenue.
That's the bedrock of it. But we have to point out a temporary but significant factor that gave them an extra lift this quarter, and that's the tax differential timing.
Yes, I was just looking at that. We have to flag this. There's a big difference between the tax expense they recorded on the P&L, 25.3 billion, and the actual cash tax paid during the quarter.
Which was only 13.72 billion.
So that difference, roughly 11.6 billion rupees, is a substantial one-time boost to the operating cash flow in Q3.
It's a huge chunk of the difference between the 47 billion profit and the 78 billion cash flow. This kind of timing difference can relate to deferred tax assets or specific payment schedules. But if we were to normalize for it, if we assume they paid the full 25 billion in cash, the CCR would definitely drop.
It would drop, but it would still be healthy, probably closer to, what, a 1.2 or 1.3 times range.
Which is still incredibly healthy for a bank. The key insight for you listening is that even after you strip out that temporary tax benefit, the CCR is still robustly positive. It's driven by the structural impairment accounting and the efficient collections. The tax timing just gave it an exceptional lift this quarter. The underlying validation of the P&L quality is sound.
And if you find this forensic level of detail helpful, spotting these temporary versus structural drivers and really understanding why a high-quality profit is grounded in cash, make sure you like this deep dive and subscribe to our channel for more of these true P&L investigations. And stick with us as we move to the balance sheet. We've established the income quality. Now we need to see where that cash went and what risks are brewing.
The balance sheet. This is the ultimate scorecard for that aggressive growth strategy we flagged at the start. Management pushed the asset book by 25%. Now we get to see the consequence of that growth on their capital and their liquidity, because growth is never free. It consumes capital.
Let's just run those figures again. Gross loans expanded 25%. That's a 381 billion rupee expansion, bringing the total buck to 1.9 trillion. Deposits grew strongly as well, up over 12% to nearly 2.6 trillion.
These are enormous growth numbers. And the consequence is immediately visible in their total capital ratio. This is the bank's buffer against unexpected losses. And it dropped slightly, from 17.65% down to 16.79%.
A drop is always a signal, but we have to put that in context. 16.79% is still comfortably above the minimum regulatory requirement, which is around 14%.
It is. But they are actively using up their buffer. It's a deliberate trade-off. They're choosing growth over capital conservatism. Every new loan they write requires a certain amount of capital to be set aside against it, and a 25% growth rate eats into that buffer very quickly.
So while 16.79 is healthy today, if they keep up this pace for another few quarters without raising new capital, they could start getting uncomfortably close to that regulatory line.
That's the risk. It's a high-risk, high-reward strategy that is entirely dependent on the quality of that new 381 billion in loans.
Which brings us right back to our first point, the rising absolute stage 3 balance. If that new loan book starts to go sour, the capital ratio gets hit from two sides. First, from the new provisions they'll need, and second, from the direct reduction in the quality of the assets themselves.
Absolutely. However, there is a core strength here that mitigates some of that risk, and that's their liquidity. If you look at the loan-to-deposit ratio, the LDR, it sits at a very comfortable 73.66%.
And what does that LDR tell us about the bank's stability?
The LDR is a fantastic measure of funding safety. 73.66% means they've only lent out about 73 cents for every dollar they hold in deposits. Anything under 80% is considered very healthy.
So they have plenty of liquidity headroom.
Plenty. They are not reliant on volatile short-term market borrowing to fund their growth. Their stable, low-cost deposit base, which we already talked about with the KAIOS ratio, provides all the funding stability they need. This is a huge strength.
Okay, let's look at asset quality again, but this time from the perspective of loss mitigation. We know new bad loans are forming, but how well are they preparing for losses on the bad loans they already have? Let's talk about coverage.
We saw Stage 3 coverage strengthen significantly. It moved from 64.6% up to 71.43%. This is a crucial number that reflects management's prudence.
So for every 100 rupees of loans they've already identified as being in deep trouble.
They've now set aside over 71 rupees to cover the expected loss. This shows that while new problems are coming in the door, they're getting much more rigorous about provisioning for the existing known risks. It's a sign of a robust risk management function reacting to historical issues.
That's a fascinating duality, isn't it? Management seems excellent at handling the credit risks of the past, strengthening coverage, impairment normalization, but they seem to be struggling to slow the rate of new credit problems in the present.
And that leads us perfectly into this segment deep dive. We need to know which parts of the bank are driving the profit and, critically, where the risk is coming from.
Let's start with the core driver, personal banking, the consumer engine. This is still their largest revenue contributor, and revenue was up a very healthy 21.8% to 49 billion. This just confirms the CSA and fee income strategies are working with retail customers.
That's the baseline of quality earnings. But the headline grabber is the corporate banking segment. Its net income doubled, a staggering 122% increase, up to 14.55 billion.
A 122% jump. We have to scrutinize that. And as we noted from the source material, this surge was driven specifically by lower impairments.
This is the third time we've come back to this point. Corporate banking is where you see those big, lumpy impairments, a major bankruptcy, a sector downturn, or provisioning against sovereign-linked bonds. As those macro risks fade, corporate banking gets the biggest benefit on the P&L.
So the doubling in profit isn't from a doubling in lending activity, it's mostly an accounting tailwind.
It's exactly right. And when you put it all together, the group's 52% profit growth makes perfect sense. You have structural 22% growth in your biggest segment, personal, and then you couple that with a 122% accounting-driven boom in corporate.
The result is a massive beat.
We also have to look at the swing factors. The Treasury segment had a significant reversal, flipping from a 1.5 billion loss to a 3.1 billion profit. That's a material shift of over 4.5 billion.
That kind of swing suggests a really effective management of their investment portfolio. Could be favorable trading, revaluation of bonds. Maybe as interest rates stabilize, they saw some mark-to-market gains on government debt.
Very likely. And finally, the weak link. International operations. Income here is down 26.3% to just under 10 billion. This is a point of concern because international diversification is supposed to be a key strategic advantage.
A 26% drop is more than a minor headwind. What's driving that?
It's most likely due to negative foreign exchange translation. We have to explain this. When their foreign subsidiaries earn money in, say, US dollars, that income has to be translated back into Sri Lankan rupees for the group's accounts.
And if the rupee strengthens against the dollar over that period?
The foreign income, when converted, suddenly looks smaller. It's a technical accounting factor, but it really dampened the value of their diversification this quarter. We'll need to watch that segment to make sure it's just a translation issue and not an underlying weakness in those foreign markets.
Okay, we separated the accounting from the cash, the structural drivers from the temporary boosts. Let's synthesize all this into the true P&L summary for COMB. What is the final fundamental conclusion here?
The primary conclusion is that the bank's profit quality is excellent, and that's validated unequivocally by that 1.64 times cash conversion ratio. This quality comes from two structural engines that management has optimized brilliantly.
The first being that margin improvement from the CASA ratio, pushing NIM to 4.53%.
And the second being that exceptional operational efficiency, which gave them a world-class cost-income ratio of 27.95%. Those two things define a highly disciplined and structurally profitable bank.
But there's a huge strategic caveat here. This high quality is offset by the risk from that aggressive growth rate and the underlying asset quality trend.
Absolutely. The bank is running a growth strategy that dilutes its credit risk ratios. That rise in absolute Stage 3 loans from 86 billion to nearly 95 billion is the single most important caution signal in this entire report.
It suggests the underlying credit cycle isn't clean yet. And the 25% loan expansion is currently masking the problem, not solving it.
They're essentially running faster and burning through their capital buffer to maintain the illusion of a clean NPL ratio.
Okay, let's run through the final scorecard, the key metrics that really define their position.
Performance metrics are stellar. Return on equity at 21%, which is exceptional. Return on assets pre-tax at 3.19%, very profitable. And our structural health metrics are strong. NEM at 4.53, CIR at 27.95.
And on the balance sheet, we've got plenty of liquidity with that LDR of 73%, and they are strengthening their loss coverage on old, bad loans.
Correct.
So high profitability, structural efficiency, but all balanced by the risk of that aggressive growth. Which brings us to our final provocative thought for you to consider as you look towards the next quarter.
The central tension in this whole report is the direct conflict between the rising number of absolute bad loans and the falling impairment charges. We know the bank got a huge non-recurring tailwind this quarter from provision normalization.
Right.
But if the cost of new bad loans keeps rising, which is what that $8 billion jump in stage 3 loans tells us, how long can the benefit of normalization sustain this 52% profit growth?
That is the pivotal question. Their margins are excellent. Their efficiency is world-class. So the future focus has to shift entirely away from operations and onto credit risk management. Specifically, the quality of that new $381 billion loan portfolio.
Because if that stage 3 balance keeps climbing, those highly efficient margins are just going to be used to cover rising credit losses. That 28% drop in provisioning will reverse very quickly and will eat into future profits.
In short, COMB's profitability is no longer an operational story. It is now fundamentally a credit risk story. Their success over the next year depends entirely on their ability to slow the formation of new bad loans without having to slam the brakes on growth.
That's the true P&L.
Uncovered. Thank you for diving deep with us into the numbers today. We've separated the accounting profit from the cash reality and the temporary boosts from the structural drivers, leaving you with the crucial questions for the next quarter. Ensure you subscribe and share this deep dive with other serious investors who want to move beyond the headlines. We look forward to our next true P&L investigation.